Right now, we're around $88 on Brent, 82 on WTI. If we continue to see this escalation and widening of targets that are being hit, how high could these numbers go?
Thanks, Katie. So I think when we look at the escalation, we need to be really careful of how it plays out. I think the way we go back to, I would say, over $100 a barrel in crude is if the Houthis engage in this conflict, which they have not done so far, and start to target flows that are being rerouted from the Strait of Hormuz into the Red Sea through the port of Yanbu. That would be a very significant escalation and would definitely cause crude to re-rate higher, I think closer to that $95 to $100 a barrel. The second thing that we could see that would spark a rally back to those prices would be if Iran starts to target regional energy infrastructure, including refineries, which they had hit at the beginning of the conflict, or other kind of production facilities. LNG facilities have also been targeted. So I think those are the two kind of flags that the market is looking for, or two signals to say, okay, we need to reprice higher than this high 80s into the kind of high 90s, low 100s. At this point, I think, unless we see that, I think we stay within this kind of 80 to 90 range, as the market has become a little bit conditioned to the fact that these negotiations and escalations can be ebbs and flows and transits and can be dialed back very quickly. And that when they do dial back, the market immediately goes from pricing scarcity, which we're starting to see now, to pricing surplus, which is what we did about 2 weeks ago when we traded back down to around 70.
Everyone's talking about crack spreads at home like they're energy analysts these days, Rebecca. And I'm curious your thoughts on gasoline. We're at $3.98 today. I suspect we wake up to $4 a gallon next week. Is that going to be the price for the summer? And when you look at diesel, do we hold over $5?
Yeah, you're so right. The crack spreads are the kind of hot topic these days. And listen, there's a reason for it. We have lost about 5% of our refinery utilization through the course of this conflict, as well as in Russia, as well as China reducing their refining utilization. So we have in products here a situation where supply is reduced, demand hasn't come off the way you would have expected with the kind of prices we've seen, and we don't have the buffers that we have in crude in place for products. So yes, I do think at least over the course of the next month, when summer driving season is still in full effect, prices will be around $4 gasoline and $5 diesel. I don't see that reverting quickly, even if we start to see some flows come through Hormuz, just because the Russia constraints have really put another kind of tightening screw into the product market. And the U.S. refiners are running flat out, 96% right now. They are doing everything they can to supply the market and take advantage of these crack spreads. We just don't have a lot of spare slack in the refining system. So I don't see those backing off at least till late fall, and if flows start to resume through Hormuz.
Well, I'm glad you mentioned Russia, Rebecca, because obviously they've seen a number of refineries hit by Ukrainian drones. They banned exporting diesel as a result. And now we have a live conversation on Capitol Hill, a reinvigorated push to pass a Russia sanctions package due to the death of the architect of that, late Senator Lindsey Graham, which would allow for the president to tariff up to 100% countries that purchase Russian energy products. If that goes through and you therefore see less of a desire to buy Russian crude and product on the market, what could the impact of that be?
That's a great question. And the way I'd frame this is Russia, even under the most stringent sanctions package, was able to get crude out to the market through their shadow fleet. So it does sound extreme when we read the headline, and it would absolutely tighten the market. We've had some Russian sanction waivers in place throughout this conflict. They've since been unwound. This would be more aggressive. It would tighten the market, but I don't think it would completely take Russian exports to zero. I think they would continue to find ways to get barrels in the market. And there are buyers that will buy discounted crude, China and India in particular. One reason China has dialed back its imports of crude has been the fact that there aren't as many discounted barrels of Russian crude available. They used to get these discounts under this when they were sanctioned of the kind of dark barrels, and they haven't been able to access that. So it would absolutely tighten the market. I would say would probably add another $5 a premium into the price, but it wouldn't necessarily mean we see a full reduction of exports. The market has become fairly resilient under sanctions regimes, and it all comes down to enforcement, and you have to be willing to spend the money to enforce those sanctions.